Fair value gaps are a lot simpler than people make them seem. A fair value gap is basically this, guys. Here's a basic example of a fair value gap here. It is a 3 candlestick pattern. You're gonna see 1, 2, 3 candles. And inside of the middle candle here, there's basically going to be a gap inside of the market, right? And simply what that means is the wick of this last candle and the wick of this first candle are not touching, which means there is an imbalance here. There is an inefficiency at this price. What does that mean? This means here that there was so much buyers at this price point that sellers did not get a chance to get into this market right here. Okay, and that is very, very important. The reason why that's important, because that shows momentum. All right, this is literally what I use to scalp when I'm trading NAS, when I'm trading NQ, when I'm trading ES, right? We look at these because we want to see who's in control of the market. So if you're seeing bullish gaps towards the upside, that means buyers are taking over the market and there's a lot of strong buyers, right? And usually what you can do here is, of course, you have to have a lot more confluence than just a fair value gap, right? You want to see maybe the market swept liquidity down here. All right, this is literally like a picture perfect setup when you have the market sweep liquidity prior and we move towards the upside, creating a fair value gap right here. What you can do is you can set a limit order at the gap, stop loss at the low here that covered the liquidity, and you can have a nice 1 to 2 target, or you can make a 1 to 3 target, whichever one is best for you. At least a 1 to 2, okay, minimum 1 to 2. And simply what you're gonna wait for is you're gonna wait for the market to come lower back into that gap to fill that pricing, to give that efficient pricing to the market. And the reason why the market likes to come back and fill these gaps is because the market wants to be as fair as possible. So for each buyer, there has to be a seller, and for each seller, there has to be a buyer. So in this price point right here, there was neither of that, right? It was only buyers. So in order for the market to be fair, the market loves to come back and fill these gaps here. And once we fill these gaps, the market will continue going back towards the upside because buyers are taking over this market. Okay, so that is the rule of thumb when it comes to fair value gaps. This is going to be like the best entry that you can take here, you know, when we're sweeping these lows and we're creating a bullish fair value gap after sweeping liquidity. That is a nice setup. Okay, now understand, guys, I don't want you guys just trading any fair value gap that you see. Okay, do not go ahead and just start trading any fair value gap. Make sure there's confluences, make sure there's liquidity, make sure you're following structure, make sure you have you know, a nice bias with the fair value gap as confirmation for your entry. Okay, this is how we use this. The gaps are only confirmations for us to take entries, for us to see that buyers or sellers are into the market. So this is going to be the exact same thing, vice versa. So here's a bearish scenario of a bearish fair value gap. This is known as a bullish fair value gap. This is known as a bearish fair value gap. Okay, so in a bearish scenario, it's going to be the exact same thing, but flipped. Okay, you're going to have the market sweep highs, right? Sweep a point of liquidity, whether it's previous day highs, whether it's Asian highs, London highs, whatever the highs is, right? A good high for the market to sweep. Once the market sweeps those highs, you're going to have an impulsive move to the downside that creates a bearish fair value gap. Most of the time, the market likes to just come back and fill the gap and continue lower. All right, sometimes if this market is heavily bearish and we just have a lot of sellers here, the market will continue pushing lower and it will continue creating gaps towards the downside. Okay, now the thing is here, if you're seeing a series of gaps, and we're just gonna say here, boom, if you're seeing a series of gaps going to the downside, the first thing you need to understand is this is going to be the strongest gap. Okay, this is going to be the strongest gap. And two, you might need to go to a higher time frame. You might need to scale to a higher time frame, because what will happen is these 3 gaps here could be one big fair value gap on like the 1 hour time frame or the 4 hour time frame that you could just draw out as just one large gap instead of looking at 3 multiple gaps. But if you are on the lower time frames, the strongest gap is always going to be the one closest to the sweep of liquidity. Okay, so you might see the market come back, fill these gaps and not react, and then come to this gap here, which is the last gap before we took out, which is the last gap after we took out this liquidity here, and see this market drop like this. Okay, that is going to be your highest, strongest probability gap because it is the one that was closest to the sweep of liquidity, or to basically what the market did. Okay, two ways you can take entries here. First way you can take an entry here is you can take a limit order off of the gap. All right, you can take a straight limit order. This is when you have confidence that the market is bullish. You're in a bullish structure. You're in discounted pricing, right? This is a very, very, bias based trade where you are expecting the market to go higher because of previous confluences, right? You got to make sure that the fair value gap is not your only confluence here. Okay, make sure you swept liquidity, make sure you have other confluences like structure and everything like that. All right, here's another entry possibility, and this is literally what I like to do here is I'll wait until the market gets into this gap. I'll wait for a reaction and for a break of this high right here, and I'll take my entry, and my stop loss will be underneath this middle candle. If this middle candle has a wick, my stop loss will be underneath that wick. All right, and that'll be a more confirmation trade for you to take, and I'll still target my 1 to 2, or like I said, 1 to 3. Usually I like to target a 1 to 2 when I'm taking these. These are quick, aggressive entries. I'm usually doing this on like the 5-minute time frame, so I don't need this market to go bonkers. Okay, I don't need this market to moon. I'm only looking for a quick 1 to 2, a quick flip on the account. So